PayPal is down 32% in the past 5 years. They are reporting earnings this Wednesday, and in this video, I am going to do an in-depth analysis of the company by looking at the financials, the balance sheet, and using my Excel spreadsheet to calculate the intrinsic value of the company. Starting with the financials, PayPal has had massive growth over the past decade, going from $8 billion to $29 billion. In this regard, analysts are expecting them to reach $51 billion in 2028. Regarding profit and looking at free cash flow, it has taken a hit from $5 billion in 2022 to 2.7 currently. However, this was mainly due to a 0.8 billion negative impact of the European Buy Now Pay Later loan, and they guided for at least 4.6 billion in free cash flow, which is what they were doing before. In order to increase profits, they announced that they are going to lay off 9% of their workforce. In this regard, analysts are expecting them to make $10.68 in 2028. If you assign an 18p to the company then, it would make it a $192 stock, meaning a 215% total return. PayPal has a new young CEO who wants to innovate. They own other companies such as Venmo, one of the top financial apps, and they had an event last week in which they presented 6 innovations which are going to improve their products. Therefore, their fundamentals are improving and PayPal is innovating. Moreover, the fintech industry is expected to grow at a compounded annual growth rate of 11% over the coming years. Then, in order to calculate the intrinsic value of the company, I use my Excel spreadsheet, which tells me at what price you should buy your stock based on the assumptions about the future of the company that you put in. I did a 7-year analysis with low, middle, and high assumptions. These 3 numbers are the intrinsic value according to net income, and these 3 according to free cash flow. These numbers mean that in order to make the desired annual return that I have put in, which is 13%, you need to pay these prices. I went with 13% because you can get around 10% investing in an ETF. Therefore, if you take the risk of investing in an individual stock, you should desire a higher return. The stock is currently trading at $61 per share. Therefore, if the low assumptions occur, you're going to make a 7% annual return on your money. Middle 18% and high 28%. For my revenue assumptions, I did 7% annual on my low, 10% on the middle, and 13% on the high, which is around what analysts are expecting. I assumed a profit margin and free cash flow margin of 10% on the low, assuming they don't recover, 14% on the middle, and 18% on the high. Keep in mind that before this hit in free cash flow, their margin was between 16 and 18%. I assigned a PN price to free cash flow of 16, 18, and 20, and left the share outstanding change at 0%. However, they have been buying back shares and they have a share repurchase program. And if we consider that they buy back 2% of their shares annually for the next 7 years, the valuation becomes even more attractive. The Excel spreadsheet does not address any value to the balance sheet, and PayPal has a very good balance sheet with $18 billion in cash and 10 in debt. They could pay all their debt with the current cash they have. The only risk that I have found in investing in PayPal is competition, as there are a lot of companies in the fintech space. However, I believe PayPal is a well-established company that people trust with 430 million active consumers, 24 billion payment transactions, and growing the transactions per active account. In conclusion, I believe PayPal is a great company in a sector that is growing, that has a great balance sheet, good financials, and that is trading at a very attractive valuation, as we have seen on the Excel, and they are trading at a forward PE of 11. I hope you enjoyed the analysis. Let me know what you think about PayPal in the comments, and I'll see you in the next one.